covering support and resistance in depth here on this webinar. If you don't know what support and resistance is, if you don't know how to interpret it accurately, there is no way about it. There is no other way about it. You won't be able to trade. All right, so we're going to be talking about support and resistance here in depth. I'm going to do my utmost to help everyone understand what this is. If something is unclear, as per the usual, please be sure to let me know in the chat box, and we will discuss it further. But let's get cracking on this. When it comes to trading, all trading is, the simplest way to look at trading is as if it is a financial game between the bulls and the bears. Right? And the bulls just want to make the market make higher highs. They want to increase the price of a currency. The bears want to decrease the price of a currency. That's all that's going on. Backwards and forwards, your candlesticks formations, your candlesticks are a measure of that price movement against time. And what we are looking to do is we're looking to participate. Of course, we want to join the winning team. So what we're doing is we're analyzing what the market is doing, and we want to join on in to this game. This game is occurring between the two different teams, the bulls and the bears, and it has rules and objectives. We know what those objectives are. We want to look to capture as much profit as possible. All right? The bulls and the bears are trying to score points one against the other. The bulls score points by making the market price go higher. The bears score points by making the market price go lower. And naturally, they're both trying to control the game. There are going to be penalties for cheating, ask FXCM, and there will be rest periods like Saturdays when us normal traders cannot trade, or when the market creates highs and lows. We're going to talk about that here in a moment. All right? So let's talk about how the bulls go about moving the market. They maintain control of the market by making higher highs and higher lows. And if they manage to score a point that was higher than the last one, that's how they continue to create points. The bears don't forget that kind of thing. Here's an example of the bears in control of the market, right? So as the bears push the market down further to make lower lows and lower highs, they are leaving behind certain points that we're going to discuss in a moment. When the bulls manage to take control of the market, they're going to go after these points, because the whole time they don't just let the bears take control of the market. They're constantly and consistently fighting for control. And so as the bears make a push down to a lower point, the bulls try to fight them back up. And the bears once again force them lower. The bulls try to fight them back up. Again and again and again, this is happening in the markets. So every time that they leave these highs behind, right, the bulls remember, well, we almost got them there. So the next time when we finally manage to take control of this market, we're going to try to recover these points that we left behind. Okay? These highs, right, where there are two to the left, two to the right, fractal highs, these are the points that the bulls are going to look to target. Here is an example of when the bulls is that same chart, right? We're looking at Euro Kiwi 4-hour chart, same chart. So after the bulls manage to take control, they consistently go right after these points, right? They're going to go score the point and they pull back, right? They score the point and they pull back. They can't infinitely, neither team can infinitely just trend in one direction. If that were the case, we could simply jump into any currency pair on any time frame at any given point in time and just buy or sell indefinitely and just watch our money grow indefinitely, right? And we know that's not the way this works. We have to actually put some thought into this. So what we do is we pay attention to when they score a point. We watch. Naturally, they're going to need a break. Once they've managed to capture a point or two, they're going to need a break to recover themselves, and then they're going to make a push for the next point, and then they'll pull back. And then they'll make a push for the next point, and then they'll pull back and continue further. This is how a trend develops. So as they go along, they leave behind highs and lows, right? Now, for highs in particular, highs are candlestick formations where there are going to be two candlesticks to the left and two candlesticks to the right, that the wicks of those two to the left and two to the right are lower than that center wick high. Right? So whatever candle's in the middle, the body types, if the candles are bullish or bearish, it doesn't matter. What does matter is that out of 5 candles, at least, out of 5 candles, the one in the middle has the highest wick value to the 2 to the left, 2 to the right, not as high as that center wick, even if it's by a single pip. Even if it's by a single pip, it has to have the most prominent wick price. If that's the case, then it's created a high. Easiest way to remember it, 2 to the left, 2 to the right. Many, many times, all the time, as a matter of fact, you're going to hear the analysts refer to highs and lows. When we're talking about highs and lows, we're talking about this. We're talking about market highs and lows, appropriate fractal highs with 2 to the left and 2 to the right. All right? Any questions on that? If you hear an analyst or a market trader's employee refer to a candlestick high or a candlestick low, we're talking about a specific candle, right? Because every single candle has an open price, a close price, a high price, and a low price. But when we're talking about a high or a low, we're talking about, since it's more than likely we're going to be talking about a fractal, and we just use the word high or low, we're referring to a appropriate 2 to the left, 2 to the right situation. All right? So here are some examples of highs on that chart that we're looking at. Okay, when we get 2 to the left, 2 to the right, even if it's by a single pip, 2 to the left, 2 to the right that are not as high as that center wick high, we've got ourselves a high. Okay, high, 2 to the left, 2 to the right, high, 2 to the left, 2 to the right, 2 to the left, 2 to the right, and so on and so on. Right? All of these are market highs. When we're talking about resistance, though, resistance is a little different. Okay, Allison says, "I can't see your screen." Allison, if you take a look at your bottom taskbar where your Windows button is, you should see like a little blue or a yellow flower, the GoToWebinar flower. If you can hear my voice, that means that my screen is open somewhere on your computer. It's just not up front. So if you click on that blue or yellow flower, it should bring this window to the front and you should be able to see what I'm doing. Okay? If not, then you may want to log out and log back in, because that doesn't sound good at all. All right, please let me know a little bit later if you have any changes. Okay. When we're talking about resistance, resistance is when you've got yourself a high, right? It's where the bears start selling enough to interrupt or reverse a price movement. All right. Now, when we're talking about resistance, not all highs are going to be levels of resistance. All right. Some past highs are just going to be highs and not current past resistance. Only past higher highs that were created from where the market is currently being traded are the current levels of past resistance. This is, in my opinion, one of the most confusing things. It's just written in a very confusing manner. All right. We're going to simplify this. And I want everyone to remember that the easiest way to remember what resistance is higher highs. Okay? So if you're sitting by yourself and you want to feel weird, repeat after me. Higher highs. Resistance is equal to higher highs. All right? When we're talking about resistance, every single level of resistance will be a high. It must be a high. It's guaranteed to be a high. If you're looking for resistance, every single level of resistance will be a high. And by that I mean 2 to the left, 2 to the right, right? Every single level of resistance is going to be a high, but not every single high is going to be a level of resistance. And the reason for that is because resistance is higher highs. Okay? Only higher highs from where the market currently is will count as levels of resistance. So if we take a look at this chart, if this is the current candle right here and we start looking back in time, naturally we can't look forward in time, right? Because if we knew that, we wouldn't have the ability or we wouldn't need to analyze the market, right? So if from the current candle we start looking back in time, welcome back, Allison. We start looking back in time, we're going to identify higher highs. So if this is my current candle, I see that this right here has 2 to the left, 2 to the right. It's a high, but it's not higher than the current candle. Ergo, it cannot be a level of resistance. So my first level of resistance is right here. And then this is a higher high, and this is a higher high, higher high, higher high, higher high, higher high, higher high, right? These levels in orange can be levels of resistance because they are higher than the high that was previous, right? Any of these other highs, or 2 to the left, 2 to the right, they cannot be counted as levels of resistance because they are not higher than the last level of resistance. So once again, resistance is perfect. Higher highs. Easiest way to remember resistance, higher highs. Right? So here's an example of the higher highs of resistance. Now, here's a little rule of thumb, okay, for everyone. If you've got levels of resistance that are within 15 pips one of the other, right, go for the slightly higher one. Right? When you're going to identify your levels of resistance, this will also apply for support, which we're going to discuss shortly. But this is a little note, a little tip of the trade, if you will. When we're talking about levels of resistance and support, if you're going to identify them and you identify two levels that are within 15 pips of one another, just go for the slightly further one. All right? Go for the slightly further one. Naturally, what the market's going to try to do is, if they can accomplish multiple goals with one shot, they're more than likely going to go for the slightly further one. So you might as well look to target that. We'll discuss that in a moment. Okay? There is an indicator that will identify these highs for you and lows. We're going to talk about lows in a moment. There is an indicator that will do that. It's called the fractals indicator, and I'll pop that in the chat box. The goal or the job of the fractals indicator is to identify highs with 2 to the left and 2 to the right, right? And lows with 2 to the left and 2 to the right. If you are using the fractals indicator, though, please note that the fractals indicator will not account for situations where you have multiple candles that have the exact same price point. Okay, so we talked about a high and a low a few slides back. Right? We talked about a high and a low with 2 to the left, 2 to the right. The criteria to determine a high and a low is always going to be the same, 2 to the left, 2 to the right. However, there are going to be times where you will get multiple candles that have the exact same wick high or candles that have the exact same wick low. Right? And especially when trying to determine something like a D extension or a level of resistance and support, this can become a little difficult. You may not know what to do. So remember that the criteria for determining a high or a low is always going to be the same, 2 to the left, 2 to the right. If you have multiple candles that share the same high or multiple candles that share the same low, but you are still able to identify after and before 2 to the left and 2 to the right, then you can still consider that value, right? Those candles that are all sharing the same high price or sharing the same low, you can consider that to be a high or a low if you can identify 2 to the left and 2 to the right beyond those two candles that are lower than the center wick high or higher than the center wick low for the lows. We're going to discuss that in a moment. Any questions on that? The fractals indicator will not do that for you. It can't do it. It's not in the programming. Doesn't know how to. Right? So you will be able to do this if you're paying attention. It's just like with any indicator. No indicator is 100% market proof. There are things that we need to pay attention to as traders, and that's one of them. All right? So when we're talking about, back to highs of resistance, when we're talking about highs of resistance, please note that these can be found on every single time frame and every single currency pair. There is not, I always get the one trader, it's usually my bottom liner friends, that they want to get to, okay, well, how do I make money of whatever it is that you're saying? Whatever it is that you're saying is not particularly important. How do I make money off of it? And the question is, how do I trade it? What's the best time frame to do it? I don't care about the details. Just tell me how to do it. So I'm going to tell you right now that you can find highs of resistance on every single currency pair, every single time frame, right? And they're going to be bespoke to that time frame because an hourly chart does not move the same as a daily chart. Daily chart doesn't move the same as a weekly chart, et cetera, et cetera. Right? You're looking at different measurements of time. So your highs and lows are going to be placed in different locations, right? A lot of the times they will meet, but they will not meet all the time. Here's an example of a weekly chart and the highs of resistance on a weekly chart. From the current candle, we work our way backwards and we see from the current candle the first high with 2 to the left, 2 to the right, then a higher high, then a higher high, a higher high, and a higher high. Everything else that is here, these are all highs, but they are not levels of resistance because they are not higher than the last level of resistance. All right? This is also an indicator that is available in the Ultimate Charting software. It's a smart tool. It's not an indicator. It's a smart tool. And what it will do is it will calculate for you your most recent level of resistance and support, your most recent levels of resistance and support. It will point them out for you on the Ultimate Charting software. We'll talk about how to work that a little bit later on. All right? So once again, when trying to identify these levels of resistance, as always, we're going to start at the current candle and we will go back in time looking for higher highs. And it's going to be like going up a flight of stairs, right? We go to the left until we bump into candles, and then we go and identify the high. That's going to be resistance. And then we're going to go continue to the left until we bump into more candles, go up, find the high. That's the next level, and the next level, and the next level. Okay? Here's a little example of that. Start at the current candle. We work our way backwards in time. Here's my first level of resistance. Continue backwards. Find the high. 2 to the left, 2 to the right. There it is. Continue backwards. Bump into candles. Continue. 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 Always looking for the higher high. Anybody know what the minimum that we're looking for is? I've shown you a couple charts with different amounts of levels of resistance on them. Anybody know what the minimum we're looking for is? The minimum is going to be 4, okay? The reason why I say that is everyone should be filling out, as you find these entry opportunities, everyone should be filling out. If we go to our VIP section, this is right on Analyst on Demand. We go to the VIP section. Everyone should be filling out their grade your trade checklist, okay? So when you click on the trader checklist, depending on which direction the market's going, right? If it's uptrend or downtrend, you select your currency pair, you select your checklist time frame, right? It's going to ask you for, if you're selling the market, it's going to ask you for your levels of support. If you're buying the market, it's going to ask you for your levels of resistance. And the reason is because we're looking for an exit. As we discussed so far with the levels of resistance, the bulls remember every time that they score one of these points and the bears just make them go even lower. That's not what they want to do. But the bears force them lower and lower, so they remember that they're leaving these points behind. These are going to be the targets that they're going to go after if they manage to take control of the market. So we want to identify at least 4 levels so we know which one is the one that makes equity management sense, which one is the minimum that we can look to go for without putting ourselves in a disadvantageous position. Right? So we're looking for a minimum of 4 levels of resistance for exits. This slideshow is being a little slow here. I apologize for that. Hello, there we go. Okay, so once again, if they're within 15 pips one of the other, right, just go for the slightly further one just to kind of help yourself along. Because more than likely when the market goes after it, they're going to go for the higher or the slightly further one. Here's an example of a chart with no visible levels of resistance, right? And the reason for that is because if we start at the current candle and we work our way backwards in time trying to find a higher high, there is nothing higher than this candle. So as a result, there's nothing visible. There are no levels of resistance on this chart. And if that's the case and you found an entry and you need to find an exit, You're going to have to compress your chart or maybe add more bars of memory to be able to identify a future exit target. Any questions on that? All right, so let's continue. I'd like for you to take a crack at this. Here's a blank chart, and I want you to visually try to assess where the levels of resistance are on this chart. Just try to find as many as you can. All right, just going to look for the levels of resistance on this chart. We'll allow a few seconds for that, and then we'll move on to the next example. We're going to do a few of these for both resistance and support. Okay, so here we have the levels of resistance on this chart. Once again, we're always starting for resistance, starting at the current candle, and we go and identify the first high, 2 to the left, 2 to the right, then the next high, 2 to the left, 2 to the right, the higher high, and then a higher high, and a higher high, and a higher high. If they're within 15 pips, right here, this is a high, 2 to the left, 2 to the right, but if they're within 15 pips one of the other, I'm simply going to forgo that and go for the slightly further one, 2 to the left, 2 to the right. Right, same thing right here, slightly higher high, I'm going for the slightly further one, 2 to the left, 2 to the right. Just let this load. I don't really know why this slideshow does this. It slows down epically. And I don't know why. It's got one job, to be a slide and just stay still. All right, so here's another example. Levels of resistance. Let's go ahead and let's identify these. It'll take a few seconds to take a visual look at this. Try to visually identify the higher highs of resistance. Okay, here are the highs of resistance for this chart, right? Higher high, higher high, higher high, higher high. Naturally, if I was looking at a buy opportunity, I'd only need to identify 4, right? I don't have to go and identify 6 and 10 or anything like that. Just 4 if and when I found a buy opportunity. Come on. Here's one more example. Okay, we'll take a few short seconds here. And this is probably going to, of course, this one jumps right along. Here are the levels of resistance here for this chart. Right? On this chart, only 3 are visible. From the current candle, a higher high, and a higher high, and a higher high. Right? So, let's go ahead and let's move on then to talk about support. Just as soon as the slideshow lets me. When we're talking about support, support is going to be just the opposite side of this coin, right? On this chart, there were no visible levels of resistance. We covered this a little earlier. When we're talking about support, though, we're talking about the opposite side of this coin. It's where the bears are trying to maintain control of the market, right? And the bears just want to do the opposite. They want to make the market make lower lows and lower highs. And they manage to score points if they can create lower lows or lows lower than the previous low. So this would be an example of when the bulls are in control of the market, driving the market ever higher, pushing for higher highs and higher lows, higher highs and higher lows. And as they go, again, as you can see, it's not in a straight line. They manage to push it higher, but the bears fight them back, right? They try to press the market back down. As the bears create these lows and they manage to kind of fight back, just not enough to be able to break the trend. As the bears leave these lows behind, they're going to remember them for future reference for when they finally do regain control of the market. They're going to look to target these areas, right? So here's that exact same chart. When the bears did manage to take control, you can see how they consistently, bam, one right after the other. They went for it, scored the point, and in this case, they blew right past it and tried to go for the second one. They were almost able to make it, pulled back, went for it, scored it, got tired, pulled back, went for the next one, scored it, got tired, pulled back, and again, just consistently. This is what they do. This is just how the market works. The sooner we can realize this, the easier it is for us to be able to identify A, when to get in, and B, when to get out. right? Believe it or not, this is also secretly what's driving the Fibonacci's support and resistance. Your Fibonacci, if you've had the opportunity to study about that, your Fibonacci simply reveals hidden levels of support and resistance to you that you cannot readily see, right? But if you place a line at any one of the Fibonacci levels, you go back in time, you'll see how the market has come back to hit that price point and bounced off of it, either to the north as support or to the south as resistance. Right? So when we're talking about lows, again, lows are just going to be the opposite of highs. Lows are candlestick formations where you have two to the left and two to the right that are going to be higher than that center wick low. Right? Two to the left, two to the right. Every single candlestick formation has an open, a close, a high, and a low. But when we're talking about the actual high, an actual market high, or a fractal, we're talking about two to the left, two to the right. Okay? Two to the left, two to the right every time. So if that's going to be the case, we want to be paying attention to this, because these are going to be what's going to lead to levels of support being created. If you are a user of the fractals indicator, traders, be aware of the fault of the indicator, right? The indicator will not be able to identify multiple candles that share the exact same low. The criteria for determining a low is the same as the criteria for determining a high. We're looking for two to the left, two to the right. So if the market fails to give you two to the left, two to the right, then it's not going to be a low. If you get multiple candles that share the exact same low, and then you get two to the right and two to the left. Let's say I have three candles that have 1.015 as the high price. And then the two candles to the left of it are lower, and then after that I get two candles that are lower than those two candles, 1.015. I've got three candles that have the same price, but I can consider that price point to be a high, okay, because numerically they are the exact same, but there are two to the left and two to the right, so I can consider that price point to be a high or a de-extension if that's where the market has hit. Okay, that will count as a high or a low. The fractal indicator won't be able to identify it, but you sure will. Okay, so here are some examples of lows on the chart. Okay, here is the current price. I've got a low here, two to the left, two to the right. Here's a low, two to the left, two to the right, two to the left, two to the right. All these in green have two to the left and two to the right, low price points. Now, when we're talking about support, support is going to be the opposite of resistance. There's a whole lot written on this slide, but the reality of the situation is, in short, to easily remember support, we're going to be looking for lower lows. Lower lows. We always start from the current candle when trying to identify a level of resistance or a level of support, and only lower lows will count. So the easiest way to remember support is going to be lower lows. If we go back to that chart that we were looking at before, again, if we start from the current candle, that first low is going to be a level of support. But all these other lows in green are not going to count because they're not lower than that first low. It's only when I get a lower low and a lower low and a lower low, two to the left, two to the right, that I'm going to have my levels of support become visible. So, just like resistance, you can find these on any currency pair, any time frame. You start from the current candle and you work your way backwards to the left and down to identify these lower lows, right? Bump into candles and continue to the left. This is going to be like walking down a flight of steps. And again, the purpose of this is, so if I find a sell opportunity, if I'm hunting for a sell opportunity, I know what the bears are looking to target. We start from the current level and we work our way down looking for these lower lows and a lower low, lower low, lower low. If they're within 15 pips of one another, just like resistance, we're going to ignore, right? So here's a low with two to the left, two to the right. This is not lower than this, right? So we can't count that as a level of support. If they're within 15 pips of each other, right? Here's support 2. This is a low with 2 to the left. Sorry, mouse pad. With 2 to the left and 2 to the right, right? But it's within 15 pips of this level of support. So I'm going to ignore it. I'm going to go for the slightly lower one. Right? These two really close together, slightly lower one, same thing. All right? Any questions on this before we continue? Okay. Let me just wait for this slide to, there we go. Now, again, if it's not a lower low, guys, we can't qualify it as a level of support, right? If it's not two to the left, two to the right, and it's not lower than the last level of support, it's not going to count as a level of support. If you get to a chart and you've got your current candle visible and there are no lows that are visible that are lower than the current candle, we may have to compress our chart to identify lower lows. Do not be afraid to do that. Okay, so let's go ahead, let's jump into the trading exercise here. Try to find levels of support on this chart. All right, see the lows of support here on this chart. From the first candle, we're looking for a lower low, right? Some traders may have looked at this as a potential, but we did not have two to the right of this candle, right? This is actually the lower of these two right here, and we don't have two to the right, so this cannot be a level of support. We're looking for an actual low, two to the left, two to the right. This right here did not have two to the left, two to the right, not a low. So lower lows, lower low, lower low. Let's do another example here. Just as soon as this slideshow decides it's time to go to the next slide. There's not a timer on this. There's nothing like that. But for some reason, I don't know. It's just this slideshow. I thought it was, the computer had too many things running. That's not it. It's just being silly. All right. Here's another chart. Let's go ahead. Let's try to identify some lows of support here on this. All right. Here are the lows of support from this chart. Again, we start at the current candle and we work our way lower lows, lower lows. If it's within 15 pips one of the other, we kind of go on past it, looking for lower lows of support, right? Lower lows, lower lows. If it's not a lower low, it's not going to count. Let's go ahead. Let's continue to the next example. Just have to wait a moment here for this. This is so ridiculous. Okay. So on this chart, let's try to identify the lower lows of support. Okay. The lower lows of support on this chart, again, this is a low with two to the left, two to the right, but it's not lower than the current candle, so it can't be a level of support, right? If I got in selling here, I would not want to be looking to get out here. I'm going to be looking for lower lows of support, and of course, I'm going to be looking for things that make equity management sense. So I'm going to be considering where I put my stop loss to be able to determine where my limit will be later on. Okay. Let's continue to the next slide here. Let's go ahead and identify how many levels of support do we have visible here on this chart. No levels of support visible here, right? No levels of support visible for the simple reason that there is actually, there's just the one, right? From the current candle, got one visible level of support. Everything else is not lower than that level. So since this market is not providing us with anything lower than that, we'd have to compress the chart and go to identify a lower low. Chris, you're very, very welcome. Anytime. I'm glad you got those to be able to play. I had another client that was unable to get them to operate for some reason. VLC should be able to open that, no problem. Right? Again, here, if you want to screenshot anything from this presentation, I would strongly suggest to go ahead and take a screen capture of this. This is a good reference to be able to help you identify levels of resistance and support. Again, when we're looking for resistance, we're simply looking for higher highs. It's like going up and up a flight of stairs. And when we're looking for support, we're looking for lower lows, like going down a flight of stairs. So this is a nice quick reference to help guide you with respect to support resistance. The ultimate goal is we're going to be looking for exits. Right? So on this chart, if I were looking for both of these, I would start from the current candle. I could identify the higher highs of resistance, right, and my lower lows of support from the current candle. Any questions on this so far before we continue? All right. So here's another example of resistance and support. If we're buying the market, if we're trading bullish, what we're looking to do, or what we're expecting, is that the market is looking to take out past levels of resistance. So we're going to look to use those as targets. When we look to place our entry, we get in buying the market, and our stop loss is going to be placed below a level of support, because 50% of the time when the market creates a candlestick formation, what it does is it will come back to test it. So we're going to be aware of that. We want to be cognizant of that, and we'll place our stop loss below the level of support. So if the market needs to come down and try that level of support for additional bounce, for additional support, for lack of a better word, if it needs to come down and retest it, then we don't want to be stopped out. We want to give the market the room that it needs to be able to participate in the trend. So we place our stop loss below a level of support, or below a trend line, which is just an average of levels of support, right? If we're bearish and we're looking to sell the market as it goes down to lower lows, then we're expecting the market is going to continue to take out levels of support as it moves in the direction of the bears, and we look to place our stop loss above a level of resistance, hoping that the resistance will continue to hold the market down and focus the market's attention further down. So we place our stop loss of resistance above, our stop loss above a level of resistance. So if the market decides it wants to come back up to test that level of resistance for any buying interest, we're out of the way, and when the market resumes its trend direction, we will resume to capture profit. As the bulls and the bears fight for control and try to score points one against the other, we want to pick a side, right? We don't have to remain married to a side, but we want to assess what the market's doing, right? You take a nice assessment of the market, take a look at the trend, use your trend lines, and you're going to decide what overall direction the market's going. Once you decide what direction the market's going, you stand the highest percentage chance of success in trading in the direction of the overall trend. If you pick the wrong side, you're going to lose money. Right? And it happens from time to time. It happens to the best of us. You are going to lose trades as you trade on the market. There are no 100%, no guarantees. Actually, there is one, and that is that you're going to lose at some point, right? Sooner we come to terms with that, the easier trading becomes. We don't have to worry about being perfect. There's no such thing. We're just going to do the best that we can with the information that we have available. That is the cold, hard fact about the market. Our analysis is nothing more than pattern recognition. We're trying to figure out what the market has a tendency of doing and what the market has displayed a tendency of doing. And we're going to look to take advantage of that tendency, of that pattern, of that trend. All right? When it comes to I really wish this slide would stop doing that. We want to look to get in and out of the market with using candlestick formations, right? When it comes to buying the market, we look to place the stop loss 10 pips below or beyond the last major low or level of support. So if we're just trading support and resistance or candlestick formations, then we're going to use the last level of support or the last U-turn. If we're trading with A, B, C, Ds, then we look to place our stop loss below an A. And again, this is going to allow the bears to test the low and see if there's interest in dipping further. If there's no interest, then the market should resume its overall trend. And we're going to be looking to exit 10 pips before a level of resistance, right? We'll target a level of resistance. We're actually going to look to get out slightly before it because we don't want the market to come real close and not exactly hit that target again. So we want to get out slightly before it to avoid the pullback if there is going to be one. Okay, so here's an example. The market starts to move in the direction of the bulls. I see a entry opportunity, right? The bulls took out a previous level of resistance. They scored a point. They pulled back. And now I see the markets once again giving me an opportunity to buy. So I get in buying at a bullish candlestick formation, placing my stop loss below the low support. And I'm going to look to target a higher level of resistance, a higher high, as long as it makes equity management sense. But I'm looking to get out right before. So if something like this happens, the market goes real close, doesn't quite touch the level, I want to get out right before that happens so that I don't get stuck with the pullback. Right? That is the general premise of support and resistance. When it comes to the bears, we're going to do the same thing, except it's slightly more expensive to sell the market. Right? It's slightly more expensive to sell something that you don't own in the case of the Forex. So when it comes to that, you're going to actually try to compensate for that by placing your stop loss 15 pips above resistance. Give the market a little bit more room. So you use the candlestick formation, indicating that you're going to look to participate and sell in the direction of the bears. Your stop loss is going to be placed 15 pips above or beyond a major high of resistance. If you're trading candlestick formations or if you're trading A, B, C, Ds, then it's going to go beyond the A. Realistically, your A, B boundaries are also levels of resistance and support. So again, this is just to allow the market room to test. If the market's going to test it, you're out of the way. Let them see whether or not they're going to continue to go in the retracement direction. And if there's no interest, the market should continue in the direction of the trend. And naturally, we're going to be looking to limit out right before the market hits a lower low of support that makes equity management sense. Right? We don't want to get stuck with the pullback. So again, same situation. We identify the markets moving in the direction of the bears. We get a bearish signal. We place our stop loss above the last high of resistance, and we're looking to target a previous lower low of support. We're going to look to get out before the market hits it, though, because we don't know if the market's going to make a push straight to it. We want to look to get out right before, though, so that we don't get sucked into the pullback in case it does. Right? The final thing that we want to consider here is going to be the equity management, right? The Ultimate Traders Package teaches us that we have an obligation to ourselves to protect ourselves. And we're always going to be looking to trade for more than we stand to risk. Because that way, since we're guaranteed to take losses in this market. Since we're at some point going to take a loss, we want to make sure that every time that we win counts. So we're always going to look to trade for a minimum of 1 to 1.5. That way, as we continue to win, right? If I win twice, or if I win once and I capture 1.5 times what I risk, and I take a loss, then I still have 0.5, right? If let's say I win one, I lose one, I still am positive 0.5, 0.5, 0.5, 0.5, right? And I always set myself up to be consistently profitable. I'm always going to remain in the black if this is how I trade. If I trade 1 for 1, then if I win one and lose one, or if I lose multiple times, then I'm just worse off and worse off. Right? So we're going to make sure that we're following that equity management ratio. In addition to that, we're going to calculate how much the risk is. Right? If that total risk exceeds more than 5% of our account, then we're quite simply going to pass on the trade. We're going to look for an opportunity on a different currency pair, on a different time frame, whatever is necessary to make sure that we guard our equity management. That is going to be the make or break of any trade. So make sure you do not forget that. All right. Traders, this brings us to the end of this webinar discussion. We're going to take a short break. If anybody has any questions, please feel free to let me know. You can type them in the Analyst On Demand chat box, or you can send me an email directly, wgomez@markettraders.com. We're going to take a short rest, and we're going to come back at 10:30 p.m. Eastern Time, back to Analyst On Demand, and we will discuss another educational segment at that point. Thank you all very much for joining me. I'll see you all back on AOD. This has been Will Gomez, FX Showtime.